My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Welcome back, folks. Hey, if you've been around real estate for any length of time, you're familiar with multifamily real estate investing. And it seems like a few years ago, you could do no wrong in the multifamily space. And then that kind of came to a screeching halt a couple of years ago when prices got crazy and then interest rates start to go up. And these days we're seeing a lot of multifamily syndicators and people that are in this space kind of paying the price for those go-go times. So today we got a special guest zooming in who is very, very detail focused. The devil is in the details. And Mr. Ken Gee has a ton of experience in and around detail stuff. He's a detail guy. In fact, if I'm not mistaken, Ken, you come from an accounting background. Is that correct? My God, doesn't get much more detail focused than an accountant. And then for the last 20 plus years, 26, I think, he's been in the multifamily space. And Ken is a very successful multifamily syndicator. He also manages properties, and he's a very active partner in these bigger deals. He's one of the general partners. He puts these whole projects together and helps manage them and run them. And he's been showing other people how to be successful in real estate for quite a few years. So Ken, coming in all the way from beautiful Cleveland, Ohio, welcome to the show.
Thank you so much for having me. I'm thrilled to be here.
All right, my friend, give us a big picture snapshot of what KRI Partners looks like as of August, towards the end of August 2024. What does your real estate investing business look like today?
Yeah, so it's based on the concept that if everybody knows you can make a lot of money in real estate, what most people are trying to figure out is how are they going to get in this game, right? So some people, when they take an honest look at their life, they figure out, I'm too busy. They should passively invest. So we have an entire side of our business, what's done for you. We have real estate funds. We raise money. We put our money next to their money, and we're successful in that space. Now, if you're the other type of person who wants to do your own deals, we have an entire investor education side of our business we show you exactly what we do to run our business. We tell you exactly how we underwrite. We give you the same spreadsheets. Every single thing that we do, we teach, right? So that you can become successful. So whichever side, and believe it or not, most people actually, I didn't think this would happen at first, but they actually do a little of both. Okay. Right? They start passively investing because they want to get in right away, but then they want to learn because they want to really understand what they're investing in and try to do their own deals as well. So that's what we do. So anybody that's trying to get into multifamily, we have a place for them in our organization.
So the active side of the business, what does the portfolio look like these days, Ken?
Yeah, so we're on fund number 4. So we've done plenty of syndicate. We've actually done 19 deals. We've turned 14 of those full cycle. That means that we've bought them, run them, sold them, made money, returned money to the investors, and so on. So we currently have, I don't know how many assets. We probably have 700 or 800. We've not been long-term holders of deals because we like to recycle investors' money because they love that when you do that. So we've got 700 or 800 units that we own and manage ourselves. We are now on fund number 4. So we raise money now a little bit differently than syndicators. Syndicators find the deal, then go raise the money. We've flipped that process around. We raise the money first and then go find the deal. So our current fund number 4 is up to about 15 million. We think it'll close around 20 million. And we use that money along with our own to then go out and find deals. So that's what we're doing right now.
Very, very cool. And you also manage properties for other people, if I'm not mistaken.
Yeah, we do. We've actually, our senior management teams managed about 16,000 units, but we're actually kind of winding that down. And it's, third-party management is just a tough game. And it really does distract us from doing what we do. We manage our own stuff. We've done a ton of third-party management, but that side of our business is really winding down.
And are you going to continue managing your own properties, or are you going to
Yeah.
start outsourcing that? No, you just want to manage
No.
in-house.
Yeah, yeah. We started out in Cleveland, 27 years ago, and in Cleveland, the third party management business never developed. So
Mhm.
if you bought in Cleveland, you had to figure out how to run your own stuff. So it's because nobody invests in Cleveland from outside, right? You had no reason for third party managers. So we that's how we got good at it. And now, I mean, we've just developed this whole process so much, so detailed that it's hard to find somebody that will do it as well as what
Yeah.
we think we do it. So
Yeah, no, I can definitely understand and relate to that for sure. Um, I was going to ask you, Ken, from a big picture macro perspective, you're a numbers guy, right? That's your whole background.
Mhm.
Can you explain the pros and the cons to eh, getting in and out of these multifamily deals in a relatively short period of time, like 5 years, seems like that's your sweet
Yeah,
spot, versus just getting in and hunkering down and holding on for the long term? Why do you
yeah.
prefer one over the other?
Yeah, so it's going to depend on the asset age mostly, right?
Okay.
So the older the property, this has just been my position,
Yeah.
the shorter the hold period for me. Because I worry, remember, we started out in Cleveland with stuff built in the 20s and the 30s, and it was
Yeah.
really old. And what most people don't understand is what's going on inside those walls and underground, excuse me, is not good, right? Those things, I mean, those things were not designed
It's not improving with age. Is that what I'm understanding?
it's not. It's not like a fine wine. No, it's not. No, it's not. So if we have an older asset, we like to go in, prove our, do our thing, prove
Yeah.
our model, leave some for the next guy and move on. Now our last deal that we closed, a brand new build in St. Pete, 102 units called the Levi. I mean, there is no reason why we wouldn't want to hold, we bought it. After 5 or 6 years, we'll refinance, hopefully get most of our money out
And
and
hold on
and
to
then
it.
continue to hold it. Like that's an asset that makes sense to hold,
Got
right?
it.
Because the
Got it.
insides and the undergrounds aren't deteriorating by the moment.
Yeah, you bought it brand new pretty much, right?
I did
That's
right out of lease up, yeah.
oh, very cool. So what would you say? So you've got a lot of experience working with older properties, and I think you're
Mhm.
in the B and the C space. Is that correct? Or C
We're
and the
probably B and A. I mean, we've done the C stuff, we've done
yeah
the D stuff. What happens? The natural cycle for somebody in my chair is you start out tougher and you start to upgrade the asset quality as you get more mature. I think it's because you get tired of dealing with the aggravation is
yeah
what I think really happens. But you just learn more and as you continue to be wealthier and more well known and have a better track record, you're able to raise more money. Like our current fund is probably going to be at $20 million. Well, that allows us to buy a lot higher quality asset. Now, here's what's important. Most people think, oh, if you buy a high quality asset, you'll never make money. It'll take you forever.
yeah.
But we actually make sure that we have upside in those deals.
So
And
what
it
kind of upside are you looking at in these
rent,
higher quality deals? What are you
rent.
typically seeing?
Yeah, so we like a couple $100 in upside. So we know if we can get in close to even leverage and a couple $100 in upside, we can meet our objectives with an 80-20 split with our investors. But for example, I'll use a Levi. So that property was built and leased up in about 4 months. Well, what do builders do to lease up? They discount and give away free rent,
Mm,
right? So now when you buy that, those rents they're just below market because you had a builder just trying to lease up as fast as he could. That's what he's supposed
right.
to do.
Right.
And then so we then turn those units, that's the built-in upside, for example,
Interesting.
on that property. Other properties, it's physical improvements and so on. So it just depends on the project. But people need to have an open mind when you hear value add, it can mean different things. Right?
It's not always massive renos and
That's
that
right.
sort of thing.
Yeah, yeah.
Interesting. Yeah.
Yeah. In fact, our most successful deal so far, well, we've had a lot of successful deals, but we bought a property in Winter Haven, Florida, Arbors at Garden Grove. We bought it in 2016. We raised 2.2 million to buy it, right? Our renovation budget was 50 grand. All we did was the pool area, pavers, remar side of the pool, all that stuff.
Yeah.
We've returned everybody's money. We gave them another 1,800,000. They have 5 million in equity and still cash flows. We've moved rent $665 a month since we bought
Wow.
it.
So basically
So
it was completely the rents were way under market value when you
they
purchased.
were.
That
Yeah,
was the
well,
rent.
it also helped Florida. I mean, it's in Florida, so
Yeah. Yeah.
Florida's rents
Everything
continue,
was going up. Yeah, I
and
hear
it
you.
continues to do so. Yeah, yeah. Yep.
And that's what you're really heavy into is Florida. Is that correct, Ken?
Right now, yeah. I mean, I like what I care most about is demand has to exceed supply. But our
Yeah.
current fund four, we're dedicated to Florida for that fund. Fund five will probably be willing to move to another part of the Southeast. But I just need that demand supply setup. Remember, I grew up in Cleveland
Mm-hmm.
when demand and supply was the other way around. It was not
Yeah.
in my favor. And that's tough stuff. I mean, we made money, but it's tough. So we just, if you can get that demand exceeding supply setup, that's where you should always try to be.
Are you seeing a bit of a shift in Florida? And if so, where are you starting to look, if you don't mind sharing?
Yeah, there's not. I mean, when you say shift, I don't know. Is there a demand supply shift? I mean, they're
Yeah.
not. Well, COVID drove a lot of people to Florida. That there's no doubt about that. Pre-COVID, Florida was growing. Post-COVID, it continues to grow, not as fast as it did during COVID,
Mm-hmm.
but I mean, it still is a very good demand supply setup. People still love to be there.
Yeah.
So it is not as robust as it was 2 years ago, but it's still pretty doggone robust. I mean, all of our properties are full. We've got almost no concessions. Now, other people in the markets, there's a lot of building going on. So
Okay.
if you're not careful about where you buy, you could, if you're in Orlando right now, you're kind of struggling because there's thousands of units being put into the market like all at once.
Mm.
So that kind of, hurts you a little bit. So you just got to be mindful of that kind of stuff. But even those problems are temporary. As
Right.
long as you're not over leveraged, you can manage your way through it and it'll go away because the growth will cause those units to be absorbed.
So what other markets are you starting to look towards as well in the Southeast?
Yeah, I like Charlotte. I like Charlotte
Right.
because I
Yeah.
can get there quickly from Cleveland. It's a
Okay.
American as a hub there, so it's really quick. And I just love Charlotte. I just think it's a fantastic growing market.
It's
And
getting really popular, isn't it?
it
I've heard a
is.
lot. Yeah. No, that's
Yeah, I hope I don't miss it. But you know what? Popular places, they usually stay popular, right? There's a
Mhm.
reason that they're becoming popular.
Yeah.
And so I just look for what's going to change, and I don't see anything right now changing that.
So we mentioned at the top of the call, you do a lot of training of newer investors that are
I
wanting
do.
to get into the multifamily space, and details come natural to you where they don't to some of the rest of us. So what are some of the bigger mistakes you're seeing
Yeah.
people making when they're getting into this space when it comes to the whole
Yeah.
details?
Yeah. And this is going to shock you that I'm saying this, but it's the numbers.
Yeah.
And so our first course in our program is an underwriting course. And the reason I think that's important, well, I watch people try to do the numbers. They don't understand. Somebody said that the range it should be between this and this, and they're using a lot of guesstimates and estimates and things like that. Well, I'm here to tell you that every single line in that P&L, you can prove it, right?
Mhm.
I tell our students, I said, listen, you don't know what pest control is. You know why you don't know? Because you haven't talked to the pest control company. Pick up the
Three or
phone,
four of them.
say, hey,
Yeah.
I'm buying a deal in Tampa.
Yeah.
What should I budget for pest control? Then he gives you a number, you hang up, you call one more and see if it's close. If it is, now you have an idea. Just do that one time in that market. And all of a sudden, then you have a foundation. And here's where it's really, really important. When you're trying to buy, especially in competitive markets, who's leaning on you for price? The broker.
Mhm.
And he's gonna you're and now when they don't know the numbers, what happens is the stress level for that new person goes through the roof because they don't know. Should I go up? Is it okay? Will I be okay? Is it still a good deal? Well, if you know the numbers, you know the answer to that question. So
Yeah.
what happens? It doesn't take that long to get through our course, but it includes a 6 months of Q&A, weekly Q&A that I coach them live with their real questions. And after a couple months, their their entire outlook changes because their confidence level soars because it can no longer be BS, right?
Mhm.
I teach them how you got to know what insurance is going to be. You can't take the seller's numbers. You can't do that. Same thing with taxes. Every single number there, except for repairs and maintenance, unit turn costs, and replacement reserves, you can prove out and you can make pretty good estimates for those three over the
Mhm.
long term. So that's what we teach because everybody hates going into the details, but if you just do it for a few minutes in the beginning, you just get an understanding and then you can rise back up and start, operating where you like to operate, right? But you do it with a level of confidence that other people don't have. And I'm telling you, I see people just win huge because it keeps them from doing deals they shouldn't have done.
Yeah. Yeah. No, that's it. Devil definitely is in those details. It's
Yeah.
bit me in the butt a few times, my friend. I tell you what, scientific wild ass guess is not a good way to go.
Yeah, the old wag. I know that one well. Yes. Yeah, but the key here is you don't need to stay in the details forever.
Yeah.
That's what people need to take away from this little discussion. I don't want you to spend 5 hours underwriting every deal. That's not what I want. But I mean, look, you're getting into a business. You
Mhm.
should know the business a little bit.
Yeah.
Because if you don't, here's what investors do to you. Well, how much did you budget for taxes? Because this is what investors do on webinars.
Yeah.
How much did you budget for insurance? Is insurance going up or down? Is that number good? And if you don't know, it is very hard for most people to BS people like that. You
Yeah.
can usually see it a mile away. And it takes all that fear away because no, this is what insurance is. This is why it is. I know what it is because XYZ. And it's
No,
really fun
very, very
watching
well said.
them just grow that way because they just become so empowered that now no one can push them around. No one can tell them this and that because they know the real answer.
So with everything that's going on in the markets these days, Ken, what are there any challenges with your business? Or are numbers
Sure.
still penciling out, or
No,
what
the
are the
biggest challenge
challenges
is
you're
finding
facing these?
deals. Yeah,
Yeah.
it's finding deals. It is. I mean, we look at deal after deal after deal after deal, and somebody's willing to pay more. I probably am more conservative than I should be, but you know, I'd rather pass on a deal than have to call you as my investor and say, man, I screwed up.
Mhm.
We're not going to make money on this deal. I don't want to have that conversation. I would rather say, I'm sorry, give me more time. I haven't found the deal yet. I just want to be really careful. So that's the challenge, is just finding the deals.
Maybe as we're wrapping things up here, Ken, maybe can you just explain what these blind funds look like that
Yeah.
you're working with, and how that works from your perspective and your investors' perspective?
Yeah. So the way some people, first of all, first 10 years, we didn't use anybody's money because I just didn't want to learn on someone else's dime. Then I said, okay, I'm going to syndicate. So that syndicators go find the deal, then they raise the money in a very short period of time.
Yeah,
And it is
stress, high
really
stress. Yeah.
massive stress, right? But you got to do it, right? You have to do it because investors want to see the deal. They want to see the numbers. They want to know because they know you're not that experienced yet.
Mhm.
And the challenge in Florida or other competitive markets is everybody else is syndicating.
Mhm.
So now, how do you stand out in a pool of syndicators as a syndicator? Price. You just got to raise your price. That's the only thing you can do.
Yeah.
So I said, you know what? A number of years ago, I mean, we're on Fund 4, so this is a while ago. I said, I got to stop doing this. So I said, let's flip this model around. Let's raise the money and then go find the deals. Now, it's harder to raise the money in that scenario because it's called a blind pool fund because now the investor is blind. They give you their money, they give you the subscription, and they trust you to spend their money wisely. This is the way the private equity world really works. This is how
Yeah.
institutions do it with private equity firms. And so now it just and that's why you can't do it as a beginner. No investor would trust a beginner with that kind of power. They just wouldn't. But
Right.
after 27 years, they know who we are and what we do. So we now become a massively stronger buyer. We easily stand out against the syndicators. We've already raised the money. And then, of course, we've got our own reputation and so on and so forth that helps us. So now it is not more difficult to stand out. We stand out. We
Mhm.
just do.
Yeah, you got the cash.
We got the cash, and that's why we did it. And I mean, so far we haven't been wrong. I mean,
So
in
are
our
in
very
these kind of funds, are your investors getting paid in the meantime, or not until you actually go out and purchase something?
Yeah, so here's what we do. We collect the money, we put it in what we call a temporary investment account. It's at PNC Bank,
Mhm.
and I think they're paying right now 475 as of the date that we're doing this.
Yeah.
But that money all goes back to the investors. We don't
Okay.
charge any fees against that because that wouldn't be cool.
Yeah,
And
yeah,
then when
yeah.
we find the deal, then we deploy the money. Then the whole thing starts.
Then it's okay. That makes a lot of sense. Very, very interesting, Ken. Thank you so much for shedding some light on the importance of the details. That's for sure. If people are going, hey, this Ken Gee guy seems like he knows what the heck he's talking about, we want more of him. What should they do? Where should they go?
Yeah, go to our website, kripartners.com, kripartners.com, and then you decide, do you want to be an investor? Do you want to do your own deals? And, whichever way you want to go, we can help you. So kripartners.com.
Beautiful. Ken, thanks so much. This has been a lot of fun.
Great. Thanks for having me.
All right, everybody, take care. We'll see you on the next episode. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.